Hey, good morning, everybody. It's Wednesday, July 15th, 2026. I, of course, am Hammer, founder of Hammer Solutions, home of great products to help my originator friends get more business from being found online from Google and AI search and social media. You can check out Originator Success, Grab and Go Social, and Rate Sensei, three great products that we offer. Check those out sometime. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern Time, broadcasted to you on Facebook and YouTube. Back in the saddle again. Thank goodness for high-speed internet. Sorry, yesterday was a bit of a and it was so much to say, so much to talk about. My wife offered to pull. You're making the desk. This is Sophia over here. You guys don't see her. She's over on the desk now. You're making the camera shake, Sophia. So anyway, my wife offered to pull over yesterday, and I should have just had her do it because we were in a great area for internet. And then, of course, I went live, and immediately after that, just seemed to hit these constant dead spots. So, anyway, I am here this morning. Today, we're going to be talking about what's going on with the wholesale inflation data. I'm going to talk a little bit more about that CPI data yesterday and the fact that it did come in so low. We're going to talk about what's going on with Iran, the Strait of Hormuz, and of course, where that leaves rates over the next few weeks. And we'll also talk about Mr. Kevin Warsh and the new Fed chair and his testimony in front of Congress. He is on day 2 today. He did testify yesterday. So we are all set. Remember, if you want to join me each and every weekday morning, make sure that you sign up for a text reminder at www.hmmr.io/reminder, or use this cool QR code. Sign up to get a text. I send that text out as I'm going live each day, so you don't miss a moment of the show. You could also sign up and get our email lock advice for days like yesterday when the technology doesn't work and my live is shit. You can get that at ratetextalerts.com. And of course, you can sign up and get our those are the email advice. And you can, of course, get our text alerts at I am all over the place this morning. Get our text alerts at ratetextalerts.com. Get our free daily lock advice email at ratelockadvice.com. There you go. Sorry, Sophia's got me distracted as she's over here deciding she missed me the last few days as I had been gone, and she wants to be on my lap and wants to be a lap cat this morning. So anyway, she tends to do that anyway. This is always your time when you like the mornings. You like to snuggle in the morning. So anyway, don't forget to smash that like button. Good morning to all of you. So glad to have you here. Welcome to all of the live folks. I'm going to, we are 3 minutes in, so we're going to jump in and get started. I'll start out with the technicals and we'll go from there. So let me bring up the screens and show you what we're working on this morning. So we've got a lovely day where mortgage-backed securities are up. We see some more green. They're up 14 basis points. That's going to help rate sheets improve. I'll talk more about that in a minute. 10-year treasury yield, 4.56. So we'll call it 4.57 when we round it off, but still below 4.6, which is fantastic. So let's go ahead and kind of highlight what happened yesterday. And let me refresh this so I can bring that up for you. We're going to talk about what happened yesterday. I'll do a 2-day chart. We'll kind of put everything in perspective. So yesterday, you see right here, we started the day much lower, and we got a huge jump of green, and it mortgage-backed securities bounced up right here. A huge jump on the day in the morning, and that was due to yesterday's CPI inflation data and how that came in. Yesterday's inflation data came in better than expected. Inflation slowed to 3.5% in June. Americans got a break from gas prices. Now, we know that this is due to the agreement that was put in place between Iran and the US, which has now fallen apart. And that's kind of a big deal. So, but bonds did rally yesterday. They rallied early. You could see we had a nice large green candlestick right here. This is yesterday. And after Monday we had a red candlestick. Monday we lost a lot of ground as bonds were just continuing to drift lower. You could see from the previous week, it's been a big drop. Mortgage-backed securities, they dropped. Well, I'll go more into that in a minute. But as far as yesterday goes, we had this big jump right here that we talked about, which is exactly what we, was hoping to see. It was really definitely a better reaction than I think we should have expected, because at the end of the day, The reality is that it's a one and done. There's no guarantee that we're going to see continued improvement in inflation. When it's likely, I mean, we've already seen gas prices starting to go up, oil back up to $85 a barrel right now. So it's unlikely that we're going to see that continue. And that's my big argument with this whole thing. So as far as rate sheets today, though, we also have even more improvement. You'll see that here. We've got some nice improvement, and that started actually even before, slightly before. No, but there it is. There is your jump, because the wholesale inflation. This was consumer inflation, but wholesale inflation, producer price index, wholesale inflation came in much better than even expected as well. So I put this in our text alerts yesterday that we were likely to see some kind of reaction to this, but that it wasn't likely to be a big reaction, that the reaction would be worse. So I said bonds held gains all day but didn't improve. Tomorrow's wholesale inflation data could get a positive response as well, but likely much less of one, even if favorable to bonds. And it did. It came in favorable to bonds. The overall PPI decelerated, rising 5.5% from the year before. Producer price index, excluding food and energy, so that's core, increased 4.7% from a year earlier. The report suggests a decline in energy costs helped keep inflation pressure in check last month. That likely gives the Fed more room to postpone an interest rate increase. Now, let me show you. I'm going to make this full screen for a minute so you guys can see this one, and we'll pop this out of the way. So this was yesterday. Yesterday, after the CPI inflation data, this was comparing for the July meeting. If we take a look here for the July meeting for the Fed, if we take a look, the expectation the day before, it was over a 40% expectation that we could see a rate hike in July. We had seen a big increase. A month ago, it was less than 10%. A week ago, it was 25%. And then it was up to 40%. Now, today, you look at where that's gone today, and today that has made a huge change because now it is back down to less than 10%. And again, that is because of these inflation numbers. The Fed much less likely to have to raise the Fed funds rate if inflation is indeed better than what was expected, and if it's going down, not only disinflation, but signs of actual deflation for some of the numbers where you actually have negative inflation, where you have prices going down. So this is a great thing. But here's my dilemma with all this, and here's my problem, right? So, as far as repricers today, it's moderate. I'm not comfortable with how good bonds are doing in this market. I feel like this is too strong of an overreaction. The 10-year Treasury reacting a little less than mortgage bonds. We were up to 4.62 on Monday, and it's dropped now to 4.57. Not as much of a difference, but when you look at mortgage bonds, we've really seen a strong bounce. But we still have everything that's going on in the Middle East and everything that's going on out there. U.S. launching new wave of strikes and Tehran threatening to close shipping routes, right? And right now, oil seems to be kind of holding its own, $85 a barrel. But if we go back up to this area above $100 a barrel again, and it's right around the corner, then that means that you're going to see rate sheets that are going to be pushing 6.875. You'll be looking at the high sixes. We could even get to the sevens. We're already, even if you want to say today's improvement, because mortgage bonds, again, they're improved by about 16 bips, putting us at 99.91. Last time we were around 99.91. We'll say Thursday, Wednesday and Thursday were right there, very close to that. And Wednesday and Thursday were the 8th and the 9th. And you look, 6.64, 6.65, the going into those 6.68. So we're right back in this range, and that's about as good as it's going to get. I just don't think that things are going to get better. And then if we do see oil prices continue to go higher, then you're going to see rates continue to go higher. So my lock advice remains the same. I think it's a good day to lock in some loans. I would take these rate sheets. I think that it is some of the better rates that we can count on right now. And I just don't see a clear path of continued improvement. In fact, today, if we didn't see what we did see with wholesale inflation, dropping as much as it did, I don't think we'd be in the positive at all today. I think we'd probably be in the red. So I think this absolutely does help. And again, if you look at where we started the day, today we started the day in the red, 99.68 after ending yesterday at 99.77. And we got this bump because of that inflation data. But, now it's like, how long is that going to last? Now, this afternoon, you've got, forgive me, I guess this afternoon, we've got the Fed's beige book. Tomorrow we've got jobless claims. Friday we've got retail sales data. We still have, or is it retail sales or is it? Let me see. Where is the calendar? Let me make this larger so I can get their calendar. The calendar on Mortgage News Daily is messed up today. So yeah, so we've got retail sales data Thursday, and then consumer sentiment on Friday. So I don't know why, but when I was looking at the economic calendar here for these guys, it did not have that. It was kind of broken. It was showing jobless claims on Friday, which is incorrect. I don't know why they would be on the 18th. That would be weird. July 18th is actually Sunday. So I don't know Saturday. So that's definitely a very odd. I don't know what's going on here. So anyway, we'll go ahead and close that. So making sure I got everything on here and get my comments out. My lock, actual lock advice is anything less than 15 days, I would still be locking. We've improved a little bit, and these are definitely better rates. It's helped offset some of Monday's losses, but it's really difficult to anticipate that things can improve from here. We've got continued escalation in Iran, more attacks. Trump says that the U.S. is going to go ahead and that we're going to go ahead and continue to attack Iran to kind of take away their ability to until they relent on Hormuz. The U.S. launched more airstrikes in Iran on Wednesday, with President Donald Trump pledging to intensify the bombardment. Now, again, I don't want to get accused of being a Trump hater, but yesterday was just another example of Taco Tuesday. Trump had said on Monday, we're gonna guard the Strait of Hormuz and keep it open, but we're gonna charge a 20% basic toll. And the other, countries were like, yeah, let's kind of curb that because we don't really want to do that. And the reality is they would have just, we would be paying more as consumers. So, and then he went against that, said, oh, they're going to invest in America. Vague nothings. These are Trumpisms. Vague nothings, claim victory where there is no victory, and then tell everybody they're stupid for not believing you that there's victory. But we'll see. We'll see what's going on with all this. But in the meantime, this is going to continue. And as it continues, forgive me, as it continues, it's hard to expect to see oil prices that are going to stay less than $100 a barrel. If the ships are not moving, we've seen this before. We've seen how this plays out. The fact that oil is remaining at this $85 a barrel is encouraging. Treasury yields are flat. Traders weigh encouraging inflation data versus oil rebound. Treasury yields were relatively unchanged on Wednesday as traders weighed another tamer than expected inflation report, as well as the latest move in oil prices. The yield on the 10-year Treasury was less than 1 basis point lower at 4.58. So the producer price index dropped 0.3% in June. Economists polled expected the measure to be unchanged. The Fed's war with inflation isn't over by any means, as Fed Chair Warsh has made plain in yesterday's testimony. But there is good news from the front, and the odds of Fed rate hikes should continue to recede as inflation at the factory level is trending lower, and producers will not be passing on higher costs to the consumer as much as we previously thought. So that's why we're seeing this positive reaction, but I don't know. Let's see what you guys have to say on it. I'm curious. As far as lock advice goes, though, anything 15 to 30 days, if we see oil prices continue higher, along with an AI-driven economy that's still, doing super strong, it is likely markets are going to go back to pricing in one or more rate hikes. I don't see that that markets have gotten all rosy optimism, and I think it's an overreaction. And 30 plus days, I'd consider locking if you can, because I think rates are going to be higher in 30 days. I don't see much of a reason to expect that we're going to see rates that are going to drop. So let's see what you guys have to say on things. Today's friendly PPI report portends future benefits to CPI and PCE. Yep, of course, because if it's cheaper at the wholesale level, the trickle down is that it will be cheaper at the other level. You heard it on the Hammers First. Rate cut December 9th. If anything, no hikes this year. Again, Ron, Siegel, Mortimer, Randolph. We have $1, right? We do have $1 bet on this. We're good for the dollar. I will absolutely mail you the dollar if there is a Fed rate cut. To be clear, the bet is that there will not be a rate cut. I don't know that we'll necessarily see a rate hike, because I don't think a single rate hike does anything. And I don't think Warsh is going to be able to get behind. I think he's going to push against getting behind the idea of multiple hikes. I don't think he can get away with cuts, but I think he's going to have a hard sell to Trump. So we've got a lot going on with the midterms coming up soon on all this. No catalyst for rates to increase. If we see ships moving through the U.S. side of the strait, oil prices will fall, and so will rates. But even then, rates only fall nominally, 1/8 of a point at most. That's about the best that you're going to see there. And you say the U.S. side of the strait. What exactly is the U.S. side of the strait? I kind of, question that. They're working on pipelines to get oil, so the Strait of Hormuz is not such a power point in the future. But that's they're talking a year to have those in. Fed President Williams says inflation's peaked. Comments on CNBC this morning. So yeah, I mean, maybe it has. We'll see. I still saw gas prices. Again, I drove to Pittsburgh and home. Gas prices were high. I was paying $4 in Pennsylvania. I was paying $4 a gallon. Yeah, we got you. So everyone says it's $1. All right. So I'm Mortimer and you be Randolph. That's it, my friends. I'm gonna wrap it up. So I'm still locking. I don't trust that we're going to see continued improvement, but it's possible. It'll take a couple more days to sway me. If we're looking at where rate sheets are at, I mean, it's not enough to get overly excited about. Every bit does help, especially when you've got people paying rebate pricing. But I mean, we've gone from 6.75. We dropped yesterday to 6.7, and then now we are, we were at 6.75 on Monday, 6.7 yesterday. Today, we could be at 6.68, arguably 6.65, but I mean, that's still higher than what we've seen. These were the lows, but you're not going to see that unless oil goes back down to, to the $70 a barrel. What happened to my oil? Here, we'll do this. So you're not going to see that unless oil goes back down into the low 70s. We need to go back to this dip right here, and I don't think we're going to see that. So that's my take on it. Anyway, thanks. Randy said paid $3.15 for gas this week in Salina. Is Salina in Texas? I'm assuming, my man. Tripping over pennies, lock and sleep good. Yeah, exactly. Brian said tripping over pennies, lock and sleep good. Yeah, I agree. There's not enough, but we could see oil jump. Again, if traders get scared, things get bad quick. If oil jumps over $100 a barrel, you're going to see rates jump another 1/8 of a point. It's just not worth it. So that's my take as well, my friends. All right, I'm going to wrap it up. Thank you again for joining me. Sorry for yesterday's terrible live, but thank you for joining me today. I'll see you guys tomorrow, and we'll see what tomorrow brings. Take care, everybody. Bye-bye.